So much news on what the Fed is doing, especially if you're looking to buy a car or a house. You really focus on every article, every story that comes out about what the Fed is doing, what the rumors are, and what they plan on doing. It's important to know how mortgage interest rates or car loan interest rates are affected by the Fed funds rate or the Fed prime rate. So you may be surprised to learn that they're not directly super correlated. We'll show here that the Fed funds rate is now at 5.5% and has been there since the end of July. That's the last quarter point rate hike that the Fed did. So if that's at 5.5%, then why is the mortgage rate so much higher, right? In fact, we topped out at the end of October at over 8%, either right at 8 or 8.125%, which is the highest it's been in 20 years. So why is that so much higher than the 5.5% funds rate? Well, that's because lenders need to make money. The Fed's charging that, but lenders need to pay the Fed and also make money on top of that. So you're always going to have a margin between what the Fed funds rate is and what your mortgage is, for instance, right? But it's not flat. It doesn't just go a point above that and stay flat. On a daily basis, the mortgage rate will go up or down. If you're working with a lender, you'll get probably an email every week, sometimes an email every day, showing you what the 30-year fixed mortgage rate is on that day. And that's moving around all over the place, but the Fed funds rate hasn't moved since the end of July. So why is that? Well, the mortgage market and lenders pay more attention to the 10-year treasury yield, which says, okay, 10 years out, what are we looking at for what this note's going to be worth, right? So that is a better indicator of what your 30-year fixed mortgage rates are than the Fed funds rate. So it's always going to be the 30-year fixed conventional mortgage rate is always going to be above the Fed funds rate. It's just a matter of how much. And when things are trending down, when the 10-year Treasury note is trending down like it is, that means that even without the Fed funds rate coming down, that 30-year fixed mortgage rate is going to come down. And we've seen that. Here, just in the past month and a half to 2 months, we've seen the 30-year fixed mortgage rate come from right at 8 to 8.125, all the way down to 6.6, 6.8, depending on which lender you go with. And if you're looking at an FHA or VA loan, you can get those right now closer to 6% even, maybe 6.125. So that's great news if you're looking to buy a house, especially leading, into first quarter of 2024. We're down over 1.5% off the peak that we saw at the end of October, which is great, and things are trending down still. If you have the ability to wait a little bit and hold off on buying this year, it's probably a good idea to do that. Because the Fed has indicated that they're planning on reducing their funds rate this year. They're done with the increases, so they say. Let's hope they stick to it. And now they're actually planning on decreases. And that means that by the summer, or for sure by the end of the year, we should be around 6% under. Heck, I mean, in a best case scenario world, we may even be at closer to 5.5%, which is a huge difference in your monthly mortgage payment on especially a house here in North Texas, with the average home being in the $350 to $400 range. And here in Collin County, you're in the $450 to $475 range for your average home. So a whole percentage difference in the 30-year fixed mortgage rate makes a huge difference, hundreds of dollars to your monthly payment, depending on the amount of the loan. So the mortgage interest rate is not in lockstep with the Fed funds rate. It is much closer, not 100%, but much closer correlated to the 10-year Treasury yield.